All right. Almost everybody's here. Ronald is here, so we start. Okay. Okay, with number, what did I say? Okay. Yeah. Okay, so let's go to where we left, which was yes, here. Okay, let's finish this part, and what we're trying to do here is basically the notes to the financial statements, where we have to put the insurance liability and including the loss component. Before we left for lunch, I say that this table was straightforward, except for the 34.26, and that I was going to tell you how to calculate that. Well, basically, this is what we have to do is to compare the cash flows, the original cash flows, and the new cash flows. Now here we're saying in yellow that this contract becomes onerous. So we have different cash flows, right? And so we calculate original versus new. Okay, and we know the difference. And also, there will be a difference in cash flows, and there will be a difference in what else? There will be a difference in risk adjustment. So we take into consideration the two differences, and then to that we add the contractual service margin, and that's a number. If that number is larger than 0, that means that we have a loss. And if we have a loss, we put it there under the insurance service expenses, only if that's a loss. If that number is not 0, then we don't have a loss, right? And that column is to be ignored. You don't do it. So if I go back, okay, here's the new layout. We say that we thought that the cash flows were going to be 150. Each year, but as a matter of fact, they were 200 in the second year, and then we revised the estimates for the rest of the years. So evidently, I can easily see that this contract is going to originate a loss. We know that already. So just by simple inspection, we know that this contract creates a loss. Okay. So then again, I will have to do these tables in Excel or in whatever system you use and calculate the difference in cash flows, okay? And then note that difference. And then calculate the difference in risk adjustment and note that difference. And then add the contractual service margin, and that's 34.26, okay? Which is this number here. And I have the calculation later, all right? So which is probably not very didactical, but anyway, this is how it is done, and we will see it. So here we are looking at the insurance liability. Then we are looking here at the insurance revenue. Okay, so insurance revenue is disclosure. We have to disclose this in the notes. So again, everything is familiar to us except the 34.26 that I told you how to calculate. And then we will have the insurance expenses, all right? And here is the way, what I just told you verbally, here we have it line by line. So difference in cash flows, differences in risk adjustment, plus the CSM, and then if that number is positive, which it is in this case, then we have a loss, and then we put it in the table. Okay, and then we have the same procedure, right, for the third year. Again, this 1407 would be calculated the same way. I basically look at the differences between cash flows and risk margins, and then I add the CSM, and then I have the 160 here, right? 160 in finance expenses. And basically, this is a proportion. The way it is done is that this 3404, which is sort of a 5% number, here has to be distributed between remaining coverage and loss component. And basically, I think I have here a slide. No. Yeah, here, the 160 is how it's calculated. So I will jump to that and then come back. So here I have this 34. The 34 is the insurance insurance finance expense, okay, that we have. Oh, here, as a matter of fact, it's very clear. Here we have the 34, and then we take the proportion of this 3426, okay, and we divide that by 696, which is the opening balance of the liability, okay, or of the remaining coverage. You will see that number here. Okay, so this proportion is kind of an artificial allocation, but that's okay. It's not going to it's not going to have any impact whatsoever. It's just for presentation purposes. So if I wanted to do 5% of the net of these two numbers, would be something similar, I think. Perhaps a little bit different. So it's going to make no difference at all. But this is perhaps a way to allocate, and that's it. So I go back. Here. Yeah. So we have this 160. We have explained. So we distribute this number, taking these two numbers as weights. Okay, and then the 1407 here. What happens now is that I have, again, the same procedure. I recalculate, and then I compare that with original. Okay, so outflows recalculated, then risk adjustment recalculated, and then I have here, this is A, this is B, okay, A plus B, and then I multiply that by a factor, and the factor is C divided by C plus D, where C is the loss component, and D is the opening balance of the liability. So it's a distribution, right? And that's all there is to it for the loss component. So I go forward one slide. As a matter of fact, this is an exercise, which is how to calculate that 160. I just did it. But anyway, these are the two things that are missing, and then the rest is very familiar to us. There should be no problem about that. So what we are doing effectively is that we are in the notes. We are separating. Once we get the insurance liability, we separate it into two components. One is a liability for remaining coverage. One is a liability for incurred claims, and then that of remaining coverage, we see if there's the possibility of having a loss. If there is, then we expand the column of remaining coverage, liability for remaining coverage. If not, that's okay. We don't have to do anything, okay? Which means that we have to continuously monitor the policies, right? We have always to be watching the development of the business, and also this is where actuaries and accountants need to work together. We need somehow we. How the loss component of the insurance liability. So we continue now with, we need now number 6, 7, we need number 5. Yeah, sure.
That investment component there, is that like capital gains as well as mark to market? Is it what? Is it just book value? What is that? Just
payments that you
payments, dividends,
to the policy
cash.
yeah, that thank you. That even if the insurance event did not occur, you sometimes have to make payments. Yeah, exactly.
Right.
Yeah. Okay, so this we have seen. We need to. But why do you say 5? No, I think it's 6, 7. I think it's 8. No, I think 8. I think. Mm-hmm. Six, 7. Yeah, 8. 8. Okay, so this is I think this is the last part of the IFRS piece. Okay, we are running a bit late. We should have finished this before lunch, but that's okay. We still have some actually we don't have that much material for Solvency II. Okay, the examples can be a little longer. So I'm allowing, on purpose, we have a bit more time tomorrow to catch up in case we run out of time. So the last part is data management issues and calculation engines, and basically we speak about data management strategy. So here, to illustrate the complexity to calculate the cash flows. We do an example. So the IFRS 17, of course, requires the calculation of the cash flows for projection purposes and also for the actual cash flows. So the actual cash flows come from the accounting system, and then basically these are elements that come from the policy, right? So the policy should be able to tell us what kind of cash flows we are going to consider. So cash flows include premiums, claims, policy expenses, etc. This is money. Cash flow is always money, right? Money that we pay or that we receive. And say that we have a ordinary life insurance policy, and then this is only for long-term contracts where there's an explosion of the amount of data that we need to basically store, right? So let's say that we do monthly calculations of a 30-year contract. So 30 times 12, that's 360. And then let's say that we have 5 cash flows per contract, which is a very low number, okay? Some contracts may have 15 cash flows or something like that. So here we say that we have premium, premium, commissions, claims, and admin expenses, and whatever, some other cash flow, dividends, whatever, right? So 360 times 5, and let's say that we have a portfolio of 100,000 policies, okay? So the multiplication of everything is 180 million records, right? So these 180 million records have to be kept, right? And this is just one product. Now, if the cash flows it depends everything on the complexity of the product. Some products are very complex, and also the expenses. How do we categorize the expenses? How do we allocate these expenses to the policies and so on? So that means that not only do we have to keep the cash flows for projections, but also the actual cash flows in the systems. And then these two systems have to communicate with each other. What we, as actuaries, typically what we do is that we basically we do our projections, but not with the actual cash flows. We do our projections assuming that, okay, if we sell this product, we will have these cash flows, and these are the projections. And then with these cash flows, we calculate certain metrics, we calculate premiums, reserves, whatever. Okay, but these cash flows are not the actual cash flows. So the actual cash flows is actually the money that is coming from the company, from the policyholders, and also the money that is being allocated because of expenses. But these are actual expenses. Okay, so that's why this could be a challenge. Okay, now. 100,000 policies, is that well, there are companies, say for example Aviva, British insurer, they have about 60 million policyholders, not policies. Policies, there's a bit more because some policyholders may have 2 or 3 policies. So I don't know, 80 million, 100 million policies, right? And then the products could be very, very sophisticated. So instead of having here 100,000, we would put factor 1,000 to get 100 million, and then here we multiply that by 1,000, so that's 180 billion records, right, for a 30-year contract. And so this adds to the complexity, and the complexity is basically more demanding on the life side. The non-life side is perhaps easier because of the nature of the 1-year term nature of the contracts. Okay. Okay. Now. I have spoken about actuarial and accounting applications, and well, there are some things that we have to work with. For example, the general ledger. What is the general ledger? We call it in Spanish libro mayor. I think here they call it GL. General ledger. General ledger. Yeah, yeah. But what do we say in Portuguese? GL or? GL. Yeah, we say in Spanish libro mayor, but I don't know. You get the you know what's the general ledger where we do the bookkeeping of all the so we have sub ledgers, okay, to record the transactions. Then we have the T accounts, right? So debits, credits, and then from these debits, credits, we go to these sub ledgers, and then we go to the general ledger, which is like the book of the company, so to speak. From this book of the company, I will construct the financial statements, right? I will construct the balance sheet, I will construct the income statement, whatever. Now, the general ledger is not designed to maintain granular information. So we have credits, debits, etc., and then we have a description of the transaction. But we don't have a collection of cash flows per contract or anything like that. We don't have that yet, right? Then number 2, actual systems need to be fed continuously by the admin system. So if there's a premium received, then the actuarial system has to know this, right? Many companies don't have this at this time. So the admin system is separated from the actuarial system or systems. Now, many companies even don't have a proper actuarial, well, not a proper, but a full actuarial system. Many companies work with Excel and R and Python or whatever other type of software. But these applications are not linked to the general ledger by any means, right? Number 3, subledgers are not only used to calculate the yes.
Plano de contas.
Eh?
Plano de contas.
Okay. Plano de contas. Okay. Subledgers are not only used to calculate the CSM, but they should also provide functionality to determine exchange rates, grouping elements, etc. 4, system and process audits are more complex now. That's clear. 5, actual systems produce estimates at a given date normally. But now we need to maintain also historical information. And then we need to keep track of the CSM, right? Because we need to okay, the CSM has to, well, basically this is the profit that is being recognized, but the recognition is a function of the units of coverage. So we need to keep track of those. So you see that the actual system and then the accounting system have to be, if we have one system for everything, that would be excellent. Okay, so some companies are trying to get to that point. This may be an approach that is suitable, maybe not. What I can tell you right now is that there's no universal approach. Each company is doing their own system, their own methodology. Each company is different, so there's no universal solution. There's no universal way of doing it. There are many approaches which potentially can be followed. Okay. Now here we have basically the process flow of information. Okay. So the first is the sources of information, and then here. Okay, this is a simplification, but basically we have actuarial inputs. Okay, if it is a life product, what are the actuarial inputs? Well, the actuary will have a mortality table, for example, etc. All right, it will she will have some assumptions regarding the expenses, things like that. And also the contract data. So who owns the contract data? Well, the administration department. Administration department, once the policy is solved, right? And then it depends, because in many cases the agent or the broker captures the data into the system, but somehow we get the data from the client, all right? The data from the client, age, whatever, the characteristics of the contract, the premium. If it is a general insurance policy, then the characteristics of the property being insured, or whatever the case might be. So this is contract data. Okay, and I'm going to capture actually the policies that I sell. I don't capture policies that I don't sell. Once the contract has been issued or is going to be issued, I capture the information, and then this is the contract data. Number two, databases. Okay, so I have to construct these databases. Companies are doing that already, but I need to do a bit more. I need to validate the data, and then I have to do something called enrichment of the data. Enriquecimiento. I'm sure there's a word in Portuguese similar. Enriquecimiento. Enriquecimiento de la información. Then I have something called IFRS 17 engine, all right? So what is this engine? The engine basically is the one that is going to calculate many things. It's going to group contracts. It's also going to calculate the CSM. Well, it's going to calculate the cash flows. Maybe or maybe not. Maybe the cash flows come from another system. Could be. It's going to calculate the amortization of the CSM, etc. Right? Then we have the accounting system, right? And the accounting system is already in place. It has been in place since the beginning of the company, right? But this accounting system has to be definitely upgraded, or we have to do something about it, right? So this is the accounting processing, and we have to map this to the specific requirements of the IFRS 17. Then we continue to the subledgers. We need the account balances, and then we have identified several accounts: present value of cash flows, risk adjustment for non-financial risk, contractual service margin, liability, and then for the liability we need to split that in remaining liability and liability for incurred claims. And then if there are loss components, we also need to keep track. We need to keep track of that, and also we need to reassess whether the contract is becoming onerous or non-onerous, whether there's a loss or not. Then we need to re-evaluate the cash flows with new information. So we do estimations, and if we can do it on a monthly basis, that's okay, because anyway we are not going to do anything manually. The system is supposed to be doing that, and we want the system to do a monthly calculation if possible. of course, we are not going to report every month, but we are not going to wait until the end of the year to do our accounting. We need to, the systems have to be dynamic, okay? And then from the sub-ledgers, I go to the general ledger. I consolidate all the transactions, everything, all the different accounts. And then from this general ledger, I go to the reporting system, okay? Now the reporting system is the system that creates the statement of profit or loss, the statement of financial position, also known as balance sheet, and so on and so forth, right? So this is, and then maybe the reports, maybe I also want internal reports for my managers, maybe reports that I do not disclose to the public, but I use it for whatever reason, for planning, for budgeting, right? Then I need also, maybe I need some form of reconciliation with the solvency calculations, maybe, right? So all these things have to be taken into consideration. So we started from sources of information, then we move on to databases, the engine, the accounting system, the sub-ledgers, the ledger, and at the end of the road, we have the reporting system. And then the reporting system has an output, and this output are beautiful financial statements with all the information, all the disclosures, all the notes, etc. Okay, so it's a long process, but that's the way it is. Okay, now considerations when adopting or implementing. What do we want? Do we want minimum compliance, or do we want to transform the company? Okay, so these are the two extremes. In Europe, many companies are going to the minimum that is necessary, and some companies, particularly the large companies, are trying to go to transformation, all right? Because this is, I guess this is also an opportunity to transform the business, and the business is already being transformed by other external forces. For example, the Internet of Things and InsurTech and new technologies, new consumer attitudes, new everything. Apparently, it's like there's a lot of changes in the market. Right? There's also regulation, there's solvency, there's a world of things going on. So many companies are deciding to transform their business, and transformation also means having perhaps different departments, different way of dealing with data. I don't know. There are many things, but here we talk about 4 considerations. One is, what are the objectives of my IFRS 17 system? What is the teamwork? How the team is going to be put together? Then one thing that is important is that I need to focus really on the numbers. I do not want a fancy application. I don't, but I need an application that gives me the right numbers. And then also I need to consider the nature and the scope of the IFRS. Okay, so this is an objective setting. If I design the system without knowing the objectives, I could be inefficient. So the minimum compliance versus transformation of the company. Okay. Now, in Europe, at least, many companies are relying on external consultants, and there could be in some jurisdictions the auditors cannot provide consulting, right? And in some other jurisdictions there's no problem. But as far as I know, all companies that I have seen are having some form of consulting. Could be IT, could be processes, could be training, different levels of activity. But yeah, but in general, this is when we come to objective setting, then it's believed that it's better that the company does its own exercise, that the company establish their objectives without any input from external consultants, because external consultants sometimes we are going to to create additional processes, because it's in their interest to create additional work, right? But perhaps the objectives are, the company knows itself better than any external input that you can get. Now, teamwork, I have mentioned that already, that the teams should be multidisciplinary, and you need to involve all these areas: finance, administration, IT, actuarial, etc. Right? All these have to be have to be considered. So it's you need to have a good team, and also you need to have a leader. Many companies have three lead, like a project leader, and then they have a finance leader, an actuarial leader for the IFRS implementation. It depends on the size of the company, on the characteristics. No unique solution, but what's important is that the leader of the project is a top executive. Otherwise, you don't go very far. Okay. Then what else we said? We said the numbers. Focus on the numbers. So it's not we're not going to design a application that I can use in a tablet or a mobile or a smartphone. That would be nice to have, but it's not. What I need is a good good numbers, right? So that all the financial aspects are captured. Okay. And then number 4 is the nature, right? The nature. Okay. We have to recognize that IFRS 17 is not a one-time project. So even we cannot say, okay, let's we build the system, the engines, the workflows, etc., the processes, and then we can go on vacation, and that's it, right? Next year we use the same thing. No, it's much more than that, because it's a continuous process. So it's not a one-time project. Okay, so things that can be outsourced, the development of actuarial models, maybe, or the maintenance, the development of the IFRS 17 engine, maybe not, maybe you can build it yourself. Accounting policies, construction of sub-ledgers, maybe outsourced, maybe not. Information integration, also maybe outsourced, maybe not. It depends, right? And then the construction of reports. Now, the decision of buying versus developing with internal resources is a difficult decision, right? And then there are companies buying everything, right? Buying systems, buying ledgers, everything. There are companies buying some pieces. Most of the companies that I have known combine internal development with commercial solutions. Okay, but as far as I know, there's no standard solution in the market. So there's no company that can tell you, well, here's your system, and then you do everything is solved, and you can go on vacation to the beach. Nothing like that. Okay. Right. So talking about IT, we have IT is about as the acronym indicates, I is for information, T is for technology, information technology. So information is key here, and then we have here different 4 boxes, and we have a little clock here. These boxes with clocks is means that this is very time consuming. Okay, so this has been the experience in Europe. So we have data sources, okay, like the underwriting system, the investment management system, market data, etc. And then the transactional systems where the transactions are recorded. Okay, so that's time consuming, but not critical. It's more critical the integration, right? Integration is extraction of information, because if I have transactions, I need to what elements do I need to have to calculate the tables that we have been illustrating here, right? Remember that everything comes from the policy information, okay? So from the policy information to the tables that we have here, think of everything that has to happen, right? Then something called data cleansing, and this is critical because sometimes the information is not very clean. Most of the time the information is disorganized, unstructured. People confound Excel with structure. So they think that if I give you the data in Excel format, it's already structured. No. One thing is structured data. The other thing is Excel. That two different things. I can give you an Excel sheet that is totally disordered with many tabs, many links. No logic whatsoever, and this would be an example of unstructured information. So don't think that that data in Excel is necessarily structured. This is not the case. And what we have seen for many companies is that actuaries, well, normally we have a chief actuary or a senior actuary. And then normally we have young actuaries, junior actuaries, who unfortunately spend 80–90% of their time cleaning information, right? Cleaning the spreadsheets, right? Or maintaining systems. Okay, so this is a lot of work, a lot of talent to be dedicated to cleaning information. And why do we need to clean information? Because the information is dirty, right? Information doesn't come the way we want to do it, the way we need it, right? Sometimes from things like I don't know, the date of birth is not in the same format that I need. Or I don't know, the computer system says M for, in English, M for male, F for female, and then the other system has 1 for female and 0 for male. This type of things. One system has, monetary amounts, the other has monetary amounts in thousands, etc., right? And what happens is that, say, for example, I'm a manager and I need the claims of the last quarter. So I ask my colleague, can you give me the claims of the last quarter? And this colleague is going to go to another database and he's going to create a new one. And then this colleague is giving me this new spreadsheet that she created, okay? And then there were changes, but I don't have the changes because the changes were done who knows where, right? So this is the problem with Excel, that every person generates data, and the number of Excel sheets in the company is infinite. Cannot be infinite, but it's very, very large. Actuaries have hundreds of spreadsheets, and then we don't know which one is valid, right? Which one is valid, because information it's a problem. It's the problem of unstructured information. If you're interested, I can tell you of a company that works on that, on structuring information and they are offering some information structures for IFRS 17. They are not IFRS 17 experts, but they are experts in information management. Okay, so integration, then storage. Storage means all these 180 million records, I need to store them, right, in databases. And then also I need to make sure who has access to these databases and that these databases are secure, etc. So I have storage of claims, policies, then the output of the actuarial systems, typically the cash flow projections, etc. And then accounting and financial. And then business analytics, maybe, yeah, it would be very good to be able to extract information, statistical information about the business in order to develop key performance indicators, do financial projections, prepare reports, etc. Okay, so we have we have three main areas: actual and finance systems, okay, including the IFRS 17 engine, information control systems, and information process management. And then last is, but also very important, data security and data integrity. Okay, so so that's a challenge for IT. Okay. Then software solutions. Well, in general, this is about outsourcing. And the idea here is that some companies establish some form of a strategic alliance with service providers, which may prove useful because you expand your capacity, you expand, you reduce your risk, particularly operational risk, etc. Resource augmentation basically means having more resources, more processes, more systems, more people working. Then regarding software providers, a few comments. Well, there are very large companies like SAP, which is SAP is a German company. They do all sorts of systems, human resources. SAP has nothing to do with IFRS 17. They have developed some form of solution because they are really what they are is a software company, but their systems are for anything, human resources, logistics, all sorts of things. Okay, so they are not going to IFRS 17 is not their main business, but since they are in the software business, they are exploring opportunities there. Then there's Oracle. Oracle is a U.S. company, very large, databases. They own, for example, Java, right? And they also have what they do is that they have server applications, cloud applications. Now the cloud. What's the cloud? The idea with the cloud is that instead of having your processes locally here in this computer, the cloud is a place, right, somewhere. It's a place where I have all the data and all the processes, but then the cloud uses resources from different servers, right? So if there's some processing to do and there's no capacity in one server, the cloud uses the capacity of another server, right? So think of Amazon Web Services or Google or things like companies like that use cloud solutions. Microsoft has a cloud solution called Azure, I think it's called, right? And so cloud is integration of information, but also using computing resources from wherever they can get. Okay, so that's Oracle. Then FIS. FIS is a U.S. company, and FIS bought which one? SunGard. SunGard in turn bought a very popular software that is called Profit. So you have heard of Profit. Profit actually was developed in the UK by Deloitte, right? Actually by I think it was Woodrow Bacon. Woodrow Bacon was acquired by Deloitte, and this was a team of actuaries in the UK who developed Profit. And Profit it's like a cash flow system. I have one friend that says everything is cash flows. Everything is cash flows and risk. That's the business we are in. And so Profit was developed by this company who was ultimately acquired by Deloitte, right? And one time Deloitte lost a major deal, a major audit. Okay, and yesterday I mentioned that some audits can be as expensive as $50 million, right? Like I told you about this case of Zurich Insurance Group, who pays $50 million for the annual audit. Okay, so that's a lot of that's $1 million per week. That's a lot of money, right? So Deloitte lost a major audit contract because the company they were targeting, okay, the client, was user of Profit, okay? and profit belonged to Deloitte. So there was a conflict of interest. An audit company normally cannot do consulting, right? I cannot provide you advice and then audit you. I cannot sell you software and then audit you. That's a conflict of interest. In places like, well, it depends on the jurisdiction, but in Switzerland, for example, is strictly prohibited. Either you do the audit or you provide consulting and software and solutions, but not both. So Deloitte lost a major contract, audit contract, because they own software, these are profit software. Right? So and the profit, I don't know. This was not. It's expensive software, but they didn't make much money with that. So they decided to sell that to SunGard. They sold that to SunGard, right? And SunGard was sold to FIS. Now, FIS is a very big company, and they provide a lot of services to banks, right? And they are exploring also IFRS 17 possibilities. Companies, for example, do we have consultants here in the room? I don't want to say. Does anyone work here with Deloitte, EY? PwC, KPMG, a gentleman is leaving the room, or no? Yeah. No, I think, but again, this is off the record. It's been recorded. This is off the record, but or I suspect that EY. Well, I know that. I know that in certain countries, EY is partnering with FIS to provide IFRS 17 solutions using profit. So I've seen that, right? Which is sort of establishing a strategic alliance. Okay. Besides that, there are many players. There's I can tell you more later of small companies or not so small providing solutions. Now, these companies try to target companies selling 100 million or more in premium, US dollars, because basically they say, well, if you're smaller than that, it's not a good project for them. Now, it's no secret that again, I think it's intuitive, and I don't mean to say anything bad about anybody. I think, but where is the money? The money is in transforming the company. Okay, so consultants want you to transform your company. Okay, that's because there's a lot of money there transforming the processes, doing something called process re-engineering, like companies like Accenture. You hire Accenture, and then they transform your company, right? They basically advise you to develop new processes, everything, and they are experts doing that. And there's a lot of money in this type of business transformations. So don't be careful about whether you want to transform your business or you want minimum compliance. And maybe you can develop everything yourselves. Maybe it's very likely that can be the case, because at the end there are your actuarial systems much better than any consultant. Your accounting systems. So maybe you're good without consulting, right? And then. But then say that you want outsource certain functions. Well, you can outsource like the testing function, or I don't know, or the development of actual models, or some form of checking whether what you are doing is right. So companies are doing all sorts of combinations, right? And I know of a large company that is combining internal development with so-called vendor solutions. Okay. Okay. Any comment here? All right. Yes.
The company companies that are developing this themselves, are they hiring programmers to do this? Are
Yes, yes.
Okay. And
Yeah.
the programmers and the actuaries are working together.
Mhm.
Just starting with a blank slate and developing a CSS.
Yes, yes. Yeah, 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 yeah.
Okay.
Yeah. Yes, they are. Just Google, I don't know, IFRS 17 engines, and you will find some, yeah. You will have you will find the usual companies, but there's quite a few new players, I would say, right? And then particularly in the UK, there's very large number of vendors. I think the UK is probably way ahead in the development of IFRS 17 engines. Also Germany, France, etc. Not the US, right? Maybe there are vendors in the US, but the US has little interest in IFRS 17. It has some interest, but they don't need to comply with IFRS 17, so there's no much movement there, right? Okay, now I have a couple of slides, and we finish IFRS 17. If you're going to buy software or you're going to buy an engine, you can look at this list. So you need to ask for these things, okay? So you need the ability to generate actuarial and accounting information, that's clear. So to convert all actuarial data and all policy data into accounting entries, you need that. So your software needs to, if somebody approaches you, I have a solution for you. Okay, can you do all this list here? If they say yes, then you open the door, right? If not, then forget about it. And this is 2 pages. So modeling capabilities, the ability to use all IFRS measurement models, that should be clear. Experience adjustment should be clear, right? Because there could be changes in actual methodologies and techniques. Transition support, right? So transition is the ability to use the full retrospective, but maybe this adds to the cost. Maybe even you don't have enough data to do full retrospective, and then the software vendor says, oh, our system can do a full retrospective. So I say here, in principle, they should be able to handle everything, but then be careful with the cost as well. Then application of discount rates, that's clear. Amortizations, that's clear. Then groupings, right? So groupings is, you need to have an algorithm to group the contracts, okay? So you have portfolio, and then you have minimum three groups, the non-onerous, the onerous, and the contracts with possibility of becoming onerous, okay? Then for onerous contracts, generation and management of loss components and the reversal of losses that we saw this morning. Okay, so the software should be able to do that. Then acquisitions and transfers as well. And last but not least, reinsurance, handling the reinsurance contracts, including interfaces. And the interface has to be done with the underlying business. So if the engine handles reinsurance, but this is managed in isolation, that's no good. There has to be an interface with the business that is being reinsured. Okay, so this is sort of a handy list for you, right? To consider when buying an engine, right? If you decide to buy. If not, but if you don't decide to buy anyway, look at this list, because you should be able to perform some of these functions here. Okay, that's it about IFRS 17. Yeah, yes.
Might be a very basic question, but with all these modeling going on and looking at your seeing if it's an onerous contract or not. It kind of implies that you need to analyze your experience very well, right? Your mortality, your morbidity, your persistency, your expenses, everything, right?
Would you do that already, no? Or no?
as I'm saying, right?
Yeah.
How recent
Yeah.
would these things have to be done?
Yeah.
It makes an assumption, right? Because
Yeah.
you're saying it's an onerous treaty. I have a mortality study. Maybe you've never done a mortality study, or persistency, or morbidity, or
Yeah.
expense, etc., etc. You know, you didn't touch on that.
Well, yeah, again, IFRS 17. Yeah, thank you. Remember that IFRS 17, where's the origin? The origin is Europe, right? And Europe, at least Western Europe, is very advanced in insurance. So it's very, very advanced, very developed. Countries like Germany, UK, France, Spain, Italy, very, very advanced. Switzerland, also very advanced, very, very small. But anyway, small and not. You know that Switzerland sells about the same amount of insurance as Brazil. Switzerland, 8 million people. Brazil, a little bit more than that, right? And then the same amount of insurance, which means that Switzerland sells a lot of insurance, right, on a per capita basis. Anyway, so there are markets that are very, very advanced. So this is the origin of IFRS 17 and Solvency II, by the way. So these type of studies, persistency studies, mortality studies, and so on, are very, very common in Europe. Companies do that on a continuous basis, right? And one other phenomenon is the concentration of reinsurance. Now reinsurance is everywhere, but two of the big companies are not far away from each other, right? So it's like imagine the globe, and then 400 kilometers apart, there's one company in Switzerland and one company in Munich, right? And these are very, very close to each other. It's like in the whole world, the reinsurance is very, very specialized in this area, which is, the Bavaria in Germany, and then Zurich, right? So it's very interesting. Of course, we have reinsurers everywhere in the world, but it's like reinsurance started to become very, very powerful and very sophisticated. So having said that, yes, companies are, companies do all these type of things. Now, in other countries, because perhaps Europe is exceptional in that regard. Okay, the US is very advanced. Australia is very advanced. South Africa is advanced as well. Australia, New Zealand, Japan, and a few other countries, most of the European countries, but not everybody. The Balkans are not very advanced, actually are lagging behind. So there's not all the world is like that, but yet everybody has to comply, or most everybody has to comply with IFRS 17. So it's an added challenge if you don't do any studies now, right? And many companies are in this position, right? So I know I also have the chance to work in. We have a client in Africa, right? And Africa is very, very underdeveloped in terms of insurance, except for South Africa. Well, very underdeveloped in everything, but in insurance is very, very underdeveloped. And one thing that is very interesting is that in most industries, the gap between emerging and advanced countries is not that wide, right? So if I want to develop a web application, the top countries are here and the emerging countries are here. So there's no big difference, right? I can develop, if I go anywhere in the world, I can have an app, a web application developed in countries that you would think that are not very advanced, and the quality is going to be very similar to the advanced countries. So that would be an IT example. What about insurance? The gap this is the advanced world, and the emerging world is, downstairs. So the gap is tremendous in insurance. Why? Why is that? Well, many aspects. Perhaps one of them is culture, right? Now, I'm telling all this story because of Ronald's question, which is very motivating. You know, the fact that whereas many companies do all sorts of analysis and studies, persistency study, mortality study, also something called actual to expected mortality ratios, actual to expected persistency, and so on and so forth. These are things that are ordinary. Also, one innovation in Europe was the so-called embedded value, right? That also originated in Europe to know the value of the business, right? And then innovations like Solvency and so on, well, these come from these relatively advanced markets. So I guess the message here is that if our company is not in that state of development, it's going to be more challenging IFRS 17, absolutely. Absolutely, yes.
Checklist of experience studies that need to be done?
No, I don't. No, that's a good question, but I don't. Yeah. All right. So any other? Yes, there's a question at the back.
Regarding IFRS 17, on overheads, what can you say about the attributable overheads on onerous contracts, especially?
So the question.
That's hard.
Yeah.
I don't know how to say. I don't know if it's better. Regarding the overhead.
The overhead expenses.
Yes, exactly.
Okay.
What
Yes.
we would consider as attributable costs,
Okay. Okay. Yes.
especially on onerous contracts.
Yeah. Okay. Yeah. Yeah. This is a good question. What is overhead? Overhead basically typically refers to like the general expenses of the company. So companies will have to pay the general manager, whatever, the CEO, the president of the company. They will have to pay salary and bonuses and everything. So this is an example of overhead cost because you don't allocate or you don't attribute this cost to any business in particular, okay? So I need only to attribute to the business the cost of what can be attributed to the policies. Example, commissions. I know that commissions can be direct. I can identify which contract generated which commissions, or maybe medical exams. If I'm on the life business, then medical exams can be attributed to a specific contract. But what about the salary of the underwriter? Maybe the underwriter works for 10 different products. How can I allocate that? Okay. Yeah, that's a good exercise. The company has to decide which costs can be allocated to the policies or attributed to the policies and which cannot be. Anything that cannot be attributed is not considered under IFRS 17. A dramatic example is that you have a building and you have maintenance costs. This is not included in IFRS 17. You have depreciation. This is not included. So IFRS 17 is accounting for the insurance contracts. You also have to do accounting for everything else, right? And your profit and loss statement will have also all the depreciation costs and everything, right? So there's maybe later I can recommend to you, come to me or I come to you, I can recommend a book regarding this allocation of expenses, but it's only about life. Are you interested in life or? Yeah, okay. All right, good. What else? Any other question? No questions? Okay, so yeah, remember we started yesterday with a quote. I put it again. This is a final reflection on the IFRS 17 chapter. We saw that before, no? So this is the purpose of financial reporting, to evaluate the degree to which a firm's accounting captures its underlying business reality. Okay, so that's what we need to have in mind. Okay, now we still have a few minutes before the coffee break, so we can start with number 9. Yeah, number 9. Right. 9. ¿Cómo se dice? 9. No, 9. 9. ¿Eh? 9. So, yeah. Yeah. 5. I have only, yeah, 54. No, I hope, no, 54 is tomorrow. Yeah. Maybe. 9. Sí. Okay. Okay, so let's talk about Solvency II, and okay, we are going to basically talk about the in this first part is the background of the directive. Okay, Solvency II is to begin with, Solvency II is a law, right? So it's a law. It's called directive, right? But it's in essence it's a law. So basically, there's a story behind it. In 1974, and I can see already that many people in the audience were not even around in 1974, or many people were small children then. Oh, you know what happens in a few days? 50th anniversary of the landing on the moon, right? So who saw that in TV? Who saw that? You saw that? All right. You look much younger. Yeah. Well, I saw that. I was also a small kid. I saw that. But anyway, 1974, there was a club called the G10. Now we have something called the G7, right? But back then there was the G10, and this is the G10 basically established the Basel Committee on Banking Supervision, and then this picture that we have here is the building of the. It's called the Bank for International Settlements, and this Bank for International Settlements is kind of a clearinghouse between central banks. So they basically, if a central bank needs some financing, basically this Bank of International Settlements arranges that. Okay, and this is right across the main station, or the train station in Basel, Switzerland. You know why Basel is famous? If you say the Basel Accords, no, that's famous also for that, but why Basel is famous? Birthplace of Roger Federer. Yeah. Anyway, so 1974, the G10 established the Basel Committee of Banking Supervision and formulated the so-called Basel Accords. So the Basel, you have heard of Basel I, Basel II, Basel III, etc. So these are basically risk management accords. And, but they have no legal force. So they suggest these accords, these guidelines, and then the central bank of a country, for example, the central bank of Brazil, decides whether to adopt this accord. Or normally they do, right? And the original thing was that for every 100 reais that the bank receives, they can lend up to 92 centimos, how do you say, cents, okay? So that was the original intent, the famous 8%, many years, in 1974. So they say, if you receive a deposit of 100, you can lend 92, right? If you receive 100, you cannot lend 100 because this is too much risk. So they say this $8 in margin is sort of a risk capital, so to speak. So it was like that, 8%. You receive 100, you can lend to other customers 92, okay? And they were concerned with market risk, then credit risk, and then for the banking business and the book business. And then in parallel, there was some development, very fragmented in the world, because the banking did it very universally. All banks have more or less the same type of rules regarding risk management around the world. Okay, but insurance, very fragmented efforts, and except perhaps for the European Union, there are a few insurance directives. Okay, and they started to do what many companies in the world do right now is the so-called Solvency I type calculation. And by the way, there's nothing called Solvency I. It's like there's Rocky and Rocky II, but there's no Rocky I, right? So there's nothing called Solvency I. It's a collection of directives, but you know that for example, in general insurance, you have 16 or 18% of whichever is larger between premiums and claims. For life, you have 4% what is it? 4%? No, 3% of reserves, or no, 4% of reserves plus 3 per thousand of some amount at risk, something like that. So these are like factors to calculate solvency. Okay, and the Solvency II project started in 2001, but it was implemented first in January 1st of January 2016. Okay, and it was overseen by when they started. It was it was a project of the European Commission. So Europe is you have the European Union, right, with 28 countries, soon 27. Somebody's leaving, but you have the council, and the council is like the club of all the presidents and prime ministers. You have the commission, which runs all the business, and then you have the parliament. Okay, and the parliament represents the people, right, of these 28 countries. And some countries, it's very complex. Some countries are in the Eurozone, and some countries are not, right? And also some countries are in the Schengen agreement. So the Schengen agreement is the free transit between countries. So for example, Switzerland is not part of the European Union, but it is part of the European Economic Area, okay? And it's part of Schengen. So Schengen means that if I travel from Switzerland to Germany, there's no border, right? Or from Germany to France, there's no border. So people run freely, no problem. And if you have a passport issued by Germany, you can work in Italy, right? No problem. It's a single market, right? So Switzerland is part of Schengen, so that means they are also in this free movement of people, right? You can work anywhere, but it's not part of Europe, of the European Union. So the European Commission basically organized a committee called CEOPS, Committee of European Insurance and Operational Pensions, right? And then this became a super regulator called EIOPA. EIOPA means European Insurance and Occupational Pension Authority. Okay, so the EIOPA is the super regulator. Okay, so it's a legal entity based in Frankfurt, Germany, and this super regulator basically oversees the regulation of insurance. But still, Spain has its own insurance regulator, and France has its own insurance regulator, and Germany, and the Netherlands, and Ireland, and all the countries belonging to the European Union. Okay, so it's overseen by EIOPA, but implementation is carried out by national regulators. And the goal is to strengthen the capital adequacy and reducing the possibilities of consumer loss or market disruption. But then think of it. the very large companies in the world are the European companies, right? AXA, Generali, you name it, Allianz, Prudential UK, Prudential US is also very big. Well, MetLife is also very, very big. That's a US company. But the very, very large multinational insurance companies are based in Europe, or are European, right? Okay, so the idea was basically to have a common framework of solvency and to basically update from the so-called Solvency I, which I established. It's not the name, Solvency I, but it was a rules-based approach. So your capital, your solvency capital is a percentage of premiums, okay, which is absurd, right? Because it was a volume-based rather than risk-based, okay? Now, this is the headquarters of the European Central Bank. This is Frankfurt, Germany, and also this is where the EIOPA, the European Insurance and Occupational Pensions Authority, has its headquarters. Okay, so Solvency I established a minimum guarantee fund. It was rules-based, so you multiply, in the case of non-life, or you multiply whichever is greater between premiums and claims by a factor, and this is your solvency capital, right? So that's very simple. And then on the life side, you multiply your reserves by a factor, and that's your solvency capital, right? Very, very simple, very strange, because you don't take into consideration the nature of the risk, right? If you have diversification, then you should have some benefits to that, right? If you write all your business in one city, is different from another company writing business in 20 different cities. The company writing business in 20 different cities will have, all things being equal, less risk because it's more diversified, right? So that's the idea, okay? So basically the Solvency II went through a process of refinement through a series of so-called quiz studies. Quiz stands for quantitative impact studies. So they run many of these studies. Chile, for example, is a country who is doing this right now, these quantitative impact studies. Mexico did that as well. So basically what they ask is, we are going to have this to pass this legislation, and we want to know what is the impact to your company. So companies participated. In some countries they were required to participate. In other countries it was on a voluntary basis. And then, well, the idea of calibrating the standard formula came about. Okay, so for now we say that the system is based in 3 pillars, much like the Basel Accords. 3 pillars: Pillar 1, quantitative requirements; Pillar 2, qualitative requirements; Pillar 3, disclosure and public information. Okay, for now we say that we mentioned the 1 in 200 probability. Okay, which is the solvency capital requirement is the amount of capital that ensures that the probability of insolvency over a 1-year period is no greater than 0.5%. So 199 times out of 200 you are going to be solvent, and 1 time out of 200 times you are not going to be solvent, right? Of course, if we want to have perfect solvency, we would need to charge an incredibly large amount, right? So to assume that everybody's going to die, which is absurd, right? So there's 1 in 200 is for margin is very reasonable. Okay. All right. We are going to stop here to go to the coffee break. When we come back in about a half hour, we continue with this slide.